Yes, last week we started capital budgeting decision, and I was able to introduce you to capital budgeting. We talked about the definition of capital budgeting, the procedures involved in capital budgeting decision, and of course, the methods of project evaluation. So we talked about the discounted and non-discounted cash flow method. And we started with the discounted cash flow methods. The techniques under the discounted cash flow method, including the net present value. We also discussed the internal rate of return. And then we talk about the areas of conflicts between the decision of NPV and then the internal rate of return. We then proceeded to discussing how to compute modified internal rate of return, and that's where we stopped. So last time, today we are going to continue from where we stopped, which is modified internal rate of return. Even though I've explained the principle, I intend to solve just a small example to demonstrate the points, all the concepts that we discussed last time. Like I mentioned, when we started last week, my intention and our strategy is to explain all relevant principles and concepts associated with the topic. Then we don't take our time to do the illustrations, okay? After the explanation of all the concepts and then the underlying principles. So what we are going to be doing next are just calculations, different scenario questions. So just to boost your confidence so that on the day of your exam, when you see any question on capital budgeting, you'll be eager to solve it. All right. Okay, then. So let's start from a short illustration on the modified internal rate of return. Once we are done with the illustration, we then move to project duration. Okay. After project duration, then we now go back to non-discounted cash flow method like a payback period, accounting rate of return. Once we are done with the explanation of those, then we move to explanation of relevant cash flow. Once we are done with relevant cash flow, then we now discuss the impact of taxation and then impact of inflation in capital budgeting. Once all of this is done, so what we are going to be doing next time will then be illustrations. So I hope you will cooperate with me so that we can finish, we can complete all what I just mentioned. So quickly, let me share my screen with Mimi. You're also welcome. Jide, you're welcome.
Thank you very much, sir.
Good evening, sir.
Good evening. So let's go for this illustration number 3. Okay, let's go for this illustration number 3. I will read for you. Filipino PLC is considering an investment in a project which requires an immediate payment of 15,000 naira, followed by a further investment of 5,400 naira at the end of the first year. The subsequent return phase net cash inflows are expected to arise at the end of the following years. Required, calculate the modified internal rate of return of this project, assuming a reinvestment rate equal to the company's cost of capital of 18%. So that is the question. Examiner wants you to calculate modified internal rate of return. Like I explained to you, the modified internal rate of return can be computed using either terminal value method or present value method. And that whichever of the two methods that you use, you are going to arrive at the same answer. Okay. So as far as this question is concerned, I will demonstrate the two techniques for you, the two methods of computing modified internal rate of return, so just for you to have the understanding of that fact that the two of them will achieve the same result. So after this, we then move to the next one. Okay then, so how do you solve this question? So let me switch. Please open to the material. I will need one of you to reshare the capital budgeting notes on the SFM group so that those that are just joining can pick the note from there. Thank you. As you do that. So I will stop sharing this. Let me go to the working notes so that within the next 20 minutes or thereabouts, we are done with this. Okay. So we want to compute modified internal rate of return. The name of this company is Filipino. PLC. So I will then say calculating modified internal rate of return. So on the day of your exam, there is no need for you to say, oh, using terminal value method or using present value method. Just go ahead and do your calculation. No need to be saying all of those. However, for the purpose of this class, we want to use the two methods. Let's start with terminal value. So I would then say, I remember I told you when you want to calculate modified internal rate of return using terminal value method, there are 4 procedures you are supposed to carry out. The first step is to calculate terminal value for all the positive cash flows. You don't calculate terminal value for negative cash flows. You only calculate terminal value for all positive cash flows because the assumption behind modified internal rate of return is that the cash flow generated by the project can be reinvested at the reinvestment rate or at the company cost of capital. So as a result, when you have negative cash flows, it means that the company is spending money on the project. So what your intention is to reinvest. Your intention is to reinvest the cash flow generated by the project. Therefore, you don't consider negative cash flows when you are calculating modified internal rate of return using terminal value method. Okay, so as a result, now the first step, like I said, is to calculate terminal value for all the positive cash flows. Step 2, you calculate present value of cash outflows. Your cash outflows can occur at the beginning of the project and also in between the years of the project. So in as much as you have negative cash flow, just calculate present value for the negative cash flow. Then step 3, you calculate modified internal rate of return using the appropriate formula that I've given you last time. Then step 4, you are going to make a decision on whether the company should accept the project or not. Of course, the company will only accept the project if your calculated modified internal rate of return is greater than the company's cost of capital. So quickly, let's go through this. So I would then say calculating terminal value. CV. So we want to use terminal value to get our modified internal rate of return. So just as if you want to calculate NPV, instead of you to discount your cash flows, we are going to compound it. So I can create column for year, another one for cash flow. Then I can have compounding factor, which is calculated as 1 plus R raised to power n minus 1. Then you can have terminal value. Okay? So I will go back to the questions. We are given cash flow from year 1 to 5. The first year cash flow is 6,500. So year 1, 2, 3, 4, then 5. Here is 6,500, 7,750, 5,750, 4,750, 3,750. So these are the cash flows as given in the question. And the examiner has told us that the cost of capital given to us is 8%. Therefore, I would then come here at 8%. This is at 8%. So like I said, instead of you to discount, you are going to compound using this formula. Therefore, I would then say 1.08. R is the 8%. N is the useful life of the project. Okay, 1 is constant. So 1.08 raised to power. The useful life of this project is 5 years. So I'm not going to be putting 5 minus 1. I just want to demonstrate for you. Now, remember I told you that the assumption behind modified internal rate of return is that the cash flow generated by the project should be reinvested at the company cost of capital or reinvestment rate. So when you look at the cash flow of year one, the cash flow of this year one, remember, before you can count 1 year, you would have accounted for, or before you can count for a year, you would have counted 12 months. So the assumption is that all the cash flow will occur at the end of each year. So the cash flow of year one, which is 6,500, you want to reinvest it. Therefore, you need to ask yourself, how many more years can you reinvest the 6,500? Of course, the year the 6,500 occur, which is year one, is irrelevant because that's the end of the year. So you only have year 2, year 3, year 4, year 5, meaning that the 6,500, you can reinvest it for the next 4 years, which is the same thing. If I say N is the useful life of this project is 5 years. So 5 minus 1 will give me 4. All right. Again, the second year cash flow. How many more years can I reinvest it? This 7,750 occurred in the second year. So the second year is gone already. So I have year 3, year 4, year 5. That means 3 more years I can reinvest the 7,750. So I can then come here 1.08 raised to power 3, which is the same thing if I say 5 minus 2, that will give me 3. Because year 1 and year 2 is already gone for the 7,750. So I have only year 3, year 4, year 5. So I would then say 5 minus 2, which gave me raised to power 3. Again, for the cash flow that occurred in the third year, I will say 1.08. How many more years can I reinvest the 5,750? I have 2 additional years, which is year 4 and 5. Therefore, I will say raised to power 2. I can also say 5 minus the 3 years that have already passed. Okay. Then the one of year 4, which is 4,750, I can reinvest it for additional 1 year. Okay, which is 5 minus 4. That will give me 1. Then the one that I'll call in year 5, 3,750. How many more years can I reinvest it? 1.08 raised to power 0. Okay, I can say since this 3,750 occurred in year 5, that will be 5 minus 5, which is equal to 0. This is what you are supposed to do because your assumption is that you want to reinvest the cash flow generated by the project. Okay, so these are the things you need to take into consideration when you are calculating your terminal value. But one more important thing I need to reemphasize is that terminal value is only computed for positive cash flows because your intention is to reinvest the cash flow generated by the project. So with this, let's move on and calculate our terminal value. I will then bring out my calculator. Let me complete my table. So from my calculator, I can say 1.08 raised to power 4 equal whatever you have in your calculator, then you multiply with the cash flow, multiply by 6.5 equal, that's 8843. Here is 8843. Move to the next one. 1.08 raised to power 3 equal, multiply by 7750 equal 9763. Here is 9763. Move to the next one. 1.08 raised to power 2 equal multiply by 5750 equal 6707. Okay. Then for the fourth year, 1.08 raised to power 1. Excuse me. Let me redo that one. 1.08. 1.08. Yeah,
That means
raised
we're
to.
using almost 4 or 5 decimal places for this to get this answer you have given us.
So just what you have in your calculator, multiply it with the cash flow.
Okay, that means almost 7 decimal places. Okay.
Multiply by 4750 equal, that's 5130. Here is 5130. Then anything raised to power 0 is equal to 1. So here is 3,750. So let's add up all the cash flows. Plus 3,750 plus 6,707 plus 9,763 plus 8,843 equal, that's 34,194, 34,193. Okay, 34,193 is the terminal value. That's the terminal value for the positive cash flows. Now that we have the terminal value, that's the first step. The second step is for us to calculate present value of cash outflows. So step 2, I would then say calculating present value of cash outflows. Okay. So in this case, I'll create a column for year, description of items. All right. Then I'll have cash flow, discount factor at 8%, then present value. Year 0, we have initial outlay of the project. Go back to the question. We are told that initial outlay is 15,000 naira. Here it will be 15,000. There's no need for you to put it in brackets because we've already said present value of cash outflow. So no need to put it in brackets. Discount factor at year 0 is 1. Multiplied by 15,000 will give us 15,000. Then we're also told in the question that the company will also incur a further investment of 5,400 at the end of the first year. So I have year 1, cash flow, 5,400. So what's the discount factor for year 1 at 8%? 1.08 raised to power 1 minus equal 0.926. 0.926. So 0.926 multiplied by 54 equal 5,000. So here is 5,000. So 5,000 plus 15,000 will give us 20,000. That means the present value of cash outflow is equal to 20,000 naira. Okay, so that's that. So we have calculated terminal value for positive cash flows. We've also calculated present value for negative cash flows. The next thing, step 3 now, is to calculate modified internal rate of return. So I would then say modified internal rate of return, which is calculated as terminal value divided by present value of cash outflow, all raised to power 1 over useful life, all minus 1. Of course, you are expected to multiply your answer with 100% because your modified internal rate of return must be in percentage. Okay, then move to the next page. So modified internal rate of return is then equal to, my terminal value is 34,193 naira divided by 20,000 naira present value, all raised to power 1 over 5 minus 1. So mathematically, what do you have here? So modified internal rate of return is equal to, bring out your calculator, 34,193 divided by 20,000 naira equal raised to power 1 divided by 5 is 0.2 raised to power 0.2 equal all minus 1 equal multiply by 100 equal 11.32. Here is 11.32%. You can say approximately 11%. So this is how to calculate modified internal rate of return using terminal value. So let's use the other method, which is present value method. So I can say alternatively, using terminal value, using present value method.
Sorry, sir, I didn't get this 11.32. I first of all divided. Okay, I first of all divided 34,193 by 20,000, and I now got my figure. I now raised it to raise to power minus 5.
It's not minus 5. You can see it's 1 over 5, not minus 5.
Okay, 34,193 by 20,000.
Raised to
So
power
how
1
do I?
over 5. Raised to power 1 over 5. 1 over 5. 1 over 5. You are going to start from the power.
That's root 5.
That's
Okay,
0.2.
okay. I got it now.
All right then.
Thank you.
Oh, you're welcome. Now, using present value method, again, there are 4 procedures you are supposed to carry out. The first procedure is to calculate present value of cash inflows. You keep it on one side. You also calculate present value of cash outflows. You keep it on one side. You calculate your modified internal rate of return, okay? Then thereafter, you advise. Those are the 4 procedures you are expected to carry out using the present value method. So let's calculate present value of cash inflows. So I would then say calculating present value of cash outflows. Total cash inflows. We've already calculated the present value of cash outflows. So here, item, I can ignore item. To save time, I'll just put cash flow. Discount factor at 8%. Then the PV. Okay. So for year 1, year 2, year 3, year 4, then year 5. Cash flow in year 1 is 6,500. Year 2, 7,750, 5,750, 4,750, then 3,750. So discount factor for year 1 at 8%, 0.926. For year 2, 1.08 raised to power 2 minus equal 0.857. For year 3, raised to power 3 minus equal 0.794. For year 4, 1.08 raised to power 4 minus equal 0.735. Then for year 5, raised to power 5 minus equal 0.681. 0.681. So let's get the present value. So now multiply 6,500 multiplied by 0.926 equal 6019. Next one, 7750 multiplied by 0.857 equal 6642. Next item, 5750 multiplied by 0.794 equal 4566. Year 3, 4750 multiplied by 0.735 equal 3491. Then 3750 multiplied by 0.681 equal 2554. Add it up. 6019 plus 6642 plus 4566 plus 3491 plus 2554 equal 23272. So that's the present value of cash inflow. We've already calculated present value of cash outflow to be 20,000 naira. Therefore, I can then go ahead. Okay. I will then say modified internal rate of return. Let me rewrite that. So it's equal to, you use the bit for nothing formula, which is present value of cash inflow divided by PV of cash outflow. Okay, raised to power 1 over n multiplied by 1 plus r. All of this minus 1. Okay, that's the formula you are going to use to calculate modified internal rate of return using the present value method. The PV of the cash inflow, like I explained to you last week, represent the PV of the return phase cash flows. Okay, so the PV of cash outflow represent the PV of the investment phase cash flows. So the PV of the return phase is when the company is reaping the benefit from the project. The PV of the cash outflow or PV of the investment phase cash flows represents the period when the company is spending money on the project. So I will then say modified internal rate of return equal to 23,272 divided by 20,000. All of this raised to power 1 over 5 multiplied by 1.08. Okay, all minus 1. You can see the formula is just bit for nothing. So bring out your calculator to get the final answer. So modified internal rate of return. So if you like, you can do it one by one so that you don't get confused. So 2923272 divided by 20,000 equal raised to power 0.2 equal 23272 divided by 20,000 equal raised to power 0.2 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 equal rais multiplied by 1.08 equal minus 1 equal multiplied by 100% equal 11.32. Our answer is 11.32%. So you confirm from your own end if your calculator gives you the same thing as 11.32. So that's the answer. So I've demonstrated the two methods for you.
11.35.
Do it again. It should be 11.32. Yeah. Okay. So examiner is asking in the question that you should calculate modified internal rate of return. That's the answer. That's the answer. We just say the Filipino PLC modified internal rate of return is 11.32%. So if the examiner is asking you to advise whether they should accept the project or not, so you need to compare your calculated modified internal rate of return with the company's cost of capital. In this case, the company cost of capital is 8%. Your modified internal rate of return is 11.32, which means the project is financially viable and should be undertaken. All right, so that's that. So let's move on to the next one. Let's go to project duration. Let me know if you have any question on this before we go to project duration. And again, please, when you have any question to ask me, always raise your
Sorry,
hand.
sir.
Just always raise your hand before you talk, okay, please, so that I can we maintain decorum in the class. You don't just interrupt me when I'm talking, please. Yes, somebody raised hand before you. I think it was Bemi. So Elvis, hold on first. You come after Bemi. Yeah, Bemi, talk to me.
Yes, you said when we're advising Filipino PLC that is a financially viable project, but then in the decision rule for MIRR,
Yep.
it says that we should reject the MIR if it is lower than the cost of capital.
Yes, now.
Sorry, it's 8%. Sorry.
Yeah. So you are fine now, Bemi.
Yes, sir.
All right then. So Elvis, talk to me.
Okay, good evening, sir. I just want to clear the air.
Yeah.
If the examiner is silent on the approach, the method to use, which one do we use? Either the terminal value or the total value.
Examiner will never ask you to use any method. So you're at liberty to use anyone that is more convenient for you. Examiner
Okay,
will not tell you. In fact, on the day of your exam, it is this bit for nothing formula examiner will give to you at the back of your question paper. You are going to see PV of return phase. PV of return phase. Return phase is the same thing as cash inflow. The PV of investment phase is the same thing as PV of cash outflow. So this bit for nothing formula that I showed arrow is what the examiner will give to you at the back of your question paper. So you are at liberty to either use terminal value method or you use present value method. And then on the day of your exam, don't go and be showing too much skills. You calculate a modified internal rate of return using terminal value. You now say, oh, in addition, this modified internal rate of return can also be calculated using present value method. You are demonstrating too much of skills. Examiner will not give you extra mark for that. You are just wasting your time. All right. So just go ahead and use any of the two that is more convenient for you. Okay. Bemi, you raise hand again. Talk to me.
No, I didn't. It's a mistake.
Okay. All right then. So let's move to, in the absence of no question, let's move to project duration. Okay, let's talk about project duration. Let me stop sharing this so that we can follow through. Okay. Let me see. Project duration. Project duration. That is not there. Okay, so let me explain project duration for you. I'm not sure because of time. Let me explain project duration for you. Let me go back to my working notes in case I want to write down something. Okay. So project duration is one of the discounted cash flow technique. Okay. Project duration. Now, what do you mean by project duration? So the project duration represents the average time taken to recoup the amount invested in a project. I repeat, project duration represents the average time taken required to recoup the amount invested in a project. It is calculated using either weighted average method or using present value method. However, the project duration is similar to the payback period, except that the project duration consider all cash flows, unlike payback periods that ignore cash flows after payback period. Okay, and not only that, the project duration consider time value of money, but the normal payback period does not consider time value of money. That's some of the difference between the two techniques. However, I will repeat again, the project duration represents the average time taken required to recoup or to recover the amount invested in a project. You want to know how long will it take you as a company to recover the amount you have invested in a project. Therefore, when you want to calculate project duration, like I said, there are two methods that you can use. You can either use present value method or you use weighted average method. Whichever of the two that you use, you are supposed to get the same answer, except to a minimal margin of error or margin of error. Okay, so minimal margin of error due to rounding. Okay, due to rounding. So two of them, the two techniques will give you the same decision and the same figure, except with a rounding error. All right, so I will demonstrate for you how to do that for the two of them. And not only that, let me see somebody, is project duration in that material? No, I can't, it's not there. Maybe it's omitted. It's omitted. Okay, but that's what I'm communicating this. So once you listen to the video, you can form a note on that. And I'll also show you, I will demonstrate all the procedures involved. So just follow through. Ayodele. Yes. So when you want to calculate project duration, there are some things you need to take into consideration. For example, if the project generates, if the project generates negative cash flow at the beginning, if you have negative cash flow at the beginning of the project, that negative cash flow should be ignored when calculating the project duration. Let me write it down. This represents the average time taken, average time taken to recover or recoup the amount invested in a project. Okay, it is calculated or project duration is similar to the normal payback period, except that the cash flows, except that project duration project duration considers all cash flows, unlike the normal payback. Unlike the normal payback periods, which ignore cash flows after payback period. Also, cash flows are discounted. Also, project duration. Project's duration considers time value of money. Okay, so I believe this is clear now. Now, calculating project duration. How do you calculate project duration? Like I said, there are two methods. You can either use weighted average method, okay, using weighted average method, or two, using present value method. Okay, these are the two methods that you can use to calculate your project duration. I will use an example to demonstrate the two for you instead of giving you formats, because the two of them you need a format to do it. But instead of giving you formats, I will use an example to demonstrate the two. Like I mentioned, whether you use weighted average method or present value method, you get the same answer, except to a minimal rounding error. Okay, that's that. However, when you are calculating your project duration, if negative cash flow is given at the beginning of the project, note, if negative cash flow is given at the beginning of the project, the negative cash flow should be ignored. When calculating project duration. However, if negative cash flow occurs in between within or between years, or occurs after year one, the negative cash flow should be included. in the calculation of project duration. So let me explain further. Let me demonstrate for you. Say, for example, we have, this is scenario 1. In this scenario, we have year 1, year 2, year 3, then year 4. The cash flow given in year 1 is 5,000 naira negative. Year 2, 8,000. Year 3, 4,000. Year 4, 6,000. So when you are calculating project duration, if you are given this kind of a cash flow, so when you are calculating project duration, you are going to ignore the negative cash flow in year 1. So you only compute project duration for the positive cash flows. All right. Now, scenario 2. Under scenario 2, say, for example, in year 1, you have cash flow of 5,000. Okay. In year 2, you have negative cash flow of 2,000. In year 3, you have cash flow of 10,000. Year 4, you also have cash flow of 1,000, for example. So in this case, because the negative cash flow occur only in year 2, you are going to include all of this in the calculation of project duration. It is only when the first year cash flow is negative that you are going to ignore that negative cash flow. So if negative cash flow occur after positive cash flow, after year 1 cash flow, then of course the negative cash flow should be included. Okay, the negative cash flow should be included. Like in this scenario 2 now, because the 2,000 negative occurs in year 2, so it should be part of the project duration. But in the scenario 1, you notice that the negative cash flow occurred in year 1. Therefore, you ignore it. You ignore the cash flow, the negative cash flow of that year 1. You focus on the one from year 2 to year 4. All right. So these are the things you need to take into consideration. So the next thing we want to do now is for me to demonstrate for you how to calculate project duration using weighted average method as well as a present value method. Okay. Let me see the material. If you have question on the project duration. Let me see. Yeah. Okay. Let me open this material and see. That. Project duration. Okay. Let's see. Okay. Stop sharing. So let's go through the examples together. Let me know if you can see my screen. Can you please?
Yes, we can see that.
All right then. So a project with an initial outlay of 200,000 naira is expected to generate the following cash inflows for the next 6 years. The cost of capital is 10% required. Calculate the project duration. So examiner wants us to calculate project duration based on the information given. So with this, what am I supposed to do? Of course, like I said, I can either use present value method or I use a weighted average method. So with this example, I'm going to demonstrate the two techniques for you so that you see whichever one that is more convenient for you. And the bottom line is that when you get to bond valuation and analysis, you are going to calculate bond duration. So it's the same thing. The same format that you use to calculate this project duration is what you are going to use to calculate the bond duration, which Mr. Ashwadi will take you later on. Okay? Ayodele private chat me after the class. All right? Okay. So let's move on. Let me start from the beginning so that you see the way I'm doing it. Okay. Can this space be sufficient for me? Let me manage one first. Let me see. Now, when you want to calculate project duration using present value method, you are going to create about 6 columns. For example, you create the first column, it should be number of years. The second column should be cash flow. I'm using this question as a format for calculating project duration. No matter how big is the question, it's the same thing. What's wrong with you? My pen is not connecting. Okay. So after cash flow, you consider discount factor. According to the question, we are given cost of capital of 10% at 10%. I hope this space will be sufficient for me. Then the next one I need to do is this space will not be sufficient. Don't let me risk it. Let me go to my working notes. Okay. So calculating project duration using present value method. Which one did I mention first? I mentioned weighted average. So let's start with weighted average. Using weighted average method, so when you want to use weighted average method, so you are going to create about 5 columns to do that. So the first column will be number of years. Second column will be cash flows. Third column will be discount factor. In this case, cost of capital given is 10%. Then the third column will be present value. Then the final column, the last column will then be the weights. Okay, so year one. In this question, in year one, we are given negative cash flows. Like I said, so in that year one, we are going to ignore negative cash flow. So therefore, we have year 2, year 3, year 4, year 5, then year 6. Cash flow for year 1, so for year 2 is 30,000, 30, 120, 30,000, 120,000, 150,000, then year 5, 100,000, then 50, 100,000, then 50,000. Discount factor at 10% for year 2, 0.826, 0.751, 0.683, 0.621, 0.50574, let me confirm, 1.1 raised to power 6 minus equal 564, okay, 0.564. So let's get the present value. So 30,000 multiplied by 0.826 equal 24,780. 24,780. Then 120,000 multiplied by 0.751 equal 9120. Next one, 150,000 multiplied by 0.683 equal 102,450. Next one, 62,100. Then the last one, 50,000 multiplied by 0.564 equal 28,200. 28,200. Add up all the present value. So plus 62,100 plus 102,450 plus 90,120 plus 24,780 equal 307,650. So that's the total present value. So let's get the weights. Of course, let me give you a shortcut or a formula. This is A, this is B, this is C, this is D, then this is E. E is equal to, D is equal to B times C, then E is equal to A multiplied by D. Therefore, 2 multiplied by 24,780, calculator. 2 multiplied by 24,780 equal 49560. Here is 49560. Next one, 3 multiplied by 9120 equal 270,360. 270,360. 4 multiplied by 102,450 equal 409,800. 409,800. I want to believe you guys are following. Ordinarily, I will expect you to be giving me the numbers. You allow me to be stressing. Huh? You should be giving me the numbers. That's what I asked you the other time. If you cooperate with me, we are going to complete all those items that I outlined. But you just allow me to be picking the number by myself. You are not participating. That's fine.
3,500.
Pardon?
310,
For the
500.
fifth year,
For the fifth year,
310,500.
310,500. Thank you.
Then the sixth year, 169,200.
169,200. So let's add up the total weights. Okay, 49,560 plus 270,360 plus 409,800 plus 310,500 plus 169,200. What do you get?
1,209,420.
1,209,420. Okay, thank you. So that's the total weights. We've also gotten the total PV. Therefore, to now get the duration is calculated as total weights divided by total PV. total PV. All of this must be expressed in years because we said that duration is a weighted average time taken to recoup the amount invested in a project. Therefore, duration is equal to 1,209,420 divided by 307,650. So what do you get?
3.93 years.
3.93 years. So that's the duration of the project. So using weighted average method, this is how to calculate project duration. So if I want to use present value method, okay, I will say calculating project duration. Alternatively, calculating projects duration using present value. Using present value method. How do you do this? It's similar to the weighted average. So I will create a column for year, cash flows, discount factor at 10%, present value. Then you are going to get the proportion of the present value of each year to the total present value. So I will have proportion of PV. Then, of course, we are going to have the last one, which is duration. Okay, so these are the 6 columns that you are going to create. Say this is A, B, C, D equal to B times C. E, then F. F equal to A multiplied by E. Okay. So year 2, year 3, 4, 5, and 6. The first year, the year 2 cash flow is 30,000 naira, followed by 120. 30,000, 120, 150. Then we have 150. 100, then 50. So discount factor 0.826, 751, 683, 621, 621, 0.564. We've calculated present value to be 24,780. 24,780. Let me write that. The next one, 9120. 102, 450. 450. And the next one, 62100. 62100. 28, 150, I guess. 28, 200. And the total PV was 307, 650. Here is 307, 650. Okay. Then we want to calculate proportion of PV. So to get the proportion of PV, you are going to divide the PV of each year with the total PV. Therefore, 24, 780 divided by 307, 650 equal. That's 0.08. Here is 0.08. Okay. Then the next one will then be 90, 120 divided by 307, 650 equal
0.292.
0.29. Okay, let's make it a 3 decimal place, 292. Oh, two decimal places, okay. Next one, 102, 450 divided by 307, 650. What do you get?
0.33.
0.33. Okay, 62, 100 divided by 307, 650.
0.20.
0.20. The last one, 28, 200 over 307, 650.
0.09.
0.09. So your total PV must be equal to 1. Your total proportion must be equal to 1. If not equal to, then you need to make one of them to be equal to, because it has to be 100%. So what do you get there? 7, remain 1. Remain 1. So let's make maybe the last one equal to 1. Okay. So that's, of course, you know, it's a rounding. We are rounding the numbers. That's why. Oh, yeah. So let's get the duration now. To get the duration, you multiply the proportion with the number of years. Therefore, 2 multiplied by 0.08. What do you get?
0.16.
0.16. Next one.
0.87.
0.8. 8
7.
what? 87.
7.
Okay. Next one.
1.32.
1.32. Next.
1.
1. And the last one.
0.6.
0.60. So let's add it up.
$3.95.
3.95. So 3.95 is the duration. The other one gave us 3.93. So because of the rounding, that's why they are not equal. So ordinarily, they are supposed to equal. But because of rounding, so you may have a minimal margin of error due to rounding. Okay, so that's that. So this is how to calculate project duration. I can then say the project duration. Let me see the first one I calculated the other time. Okay. So I can say the project duration is 3.93 years. Whichever one you have used, don't go and be demonstrating the two. Just use only one and move on. So like I said, when you get to bond valuation, so you are still going to do the same thing as this. Mr. Shiwaji will take you then. All right. So this is how to calculate duration of a project. This is how to calculate duration of a project. So let me know if you have any question for me so that we can go to the non-discounted cash flows. Any questions so far? There's no question. Mohammed, you said I'm fast.
Sorry, sir. Now I understand.
Do you get it now, Mohammed?
Sir, no problem, sir. No issues, sir.
Oh, okay. All right. So let's talk about non-discounted cash flow method. Let's talk about non-discounted cash flow method. Let me stop sharing this. So quickly, let's talk about non-discounted cash flow method. Now, remember last week, I explained that the non-discounted cash flow method, also known as traditional method of project evaluation, represents a method that does not consider the timing of cash flow and the time value of money. And the two techniques under the non-discounted cash flow method include: one, the payback period, then two, accounting rate of return. All this you have done it at the lower level, but then just to, like I said, always assume, I need you to assume zero knowledge as if you have not done it before. So let's talk about payback period. What do you mean by payback period? How do you calculate payback period? What are the decision rules under payback period? So let's talk about it. When you talk about payback period, is the period usually expressed in years in which it takes cash inflow to equal cash outflows in capital investments. Okay? Payback period is a measure of liquidity, unlike accounting rate of return, which measures profitability. So when calculating payback period, cash flow is needed. Okay, when you are calculating payback period, cash flow is needed. Anything you want to do in investment appraisal or any project evaluation techniques that you want to use, you are going to need cash flows. But if you are using accounting rate of return, you don't need cash flow, rather you need accounting profit or loss. So as a result, how do you then calculate payback period? Okay, how do you calculate payback period? Payback period can be calculated as follows, depending on whether cash flow, you have constant cash inflow, or you have irregular or non-constant cash inflow. Where cash inflow is constant, then payback period will then be the ratio of cash outflow to cash inflow. Okay, so payback period is calculated as cash outflow divided by cash inflow. All of this must be expressed in years. So this is the formula for calculating payback period, where there is constant cash inflow. Okay, what do I mean by constant cash inflow? Say, for example, in year one, examiner has given to you cash flows of 10,000 naira. Year two, 10,000 naira. Year three, 10,000 naira. So you can see the 10,000 naira is constant for the next 3 years. So as a result, instead of using table to compute your payback period, it's a waste of time. Since you know that your cash inflow is constant, simply use the format, use the formula, cash outflow over cash inflow, and you get your answer. Straightforward. Okay. Now, the other method, which is non-constant or irregular cash inflow, where you have irregular cash inflow, you are supposed to use tabular method. Okay, you are supposed to use tabular method. This is it. where you have non-constant cash inflow, you use this tabular method. So you create a column for year, you create a column for description of item if necessary, you create a column for cash flows, then you have your balance. You can call it cumulative or you call it balance. So you start from year 0. The one you have in the brackets is the cash outflow. This is the amount, is the initial outlay that you want to invest in the projects, which will also go to under balance. Therefore, the cash flow generated by these projects in year 1 is 40,000. In year 2, 70,000. In year 3, 30,000. You can see they are not constant. They are different year on year. The cash inflows are different. Therefore, when I want to calculate my payback period, I will start from my calculator. From my calculator, I will type 100,000 naira. 100,000 minus cash flow of year 1 of 40,000. So I will have balance of 60,000 at the end of year 1. So when you get to a point where your outstanding balance is less than the next cash inflow, you put a dash, then you calculate the payback period. So in this case, my payback period will then be equal to 60 over the next cash inflow, okay, plus 1. And then, of course, that is the answer I got here as 1.86. So that is how to calculate payback period where cash inflows are irregular, okay? Where cash inflows are irregular. It's pretty straightforward, except you are lucky. That's when the examiner will be asking you to calculate payback period or accounting rate of return. Questions are becoming more sophisticated in recent time. So, but again, in case the examiner wants to give you a bonus, so there's nothing bad in it. So, but it's worth knowing. Again, it's just a refresher relative to what you have done at a skills level under performance management, okay? So this is how to calculate payback period. Then what is the decision rule for payback period? What's the decision rule for payback period? For independent projects, for independent, number A, for independent projects, okay? For independent projects, accept if payback period is shorter or equal to management predetermined payback period. I repeat, for independent projects, accept if payback period, if the calculated payback period is shorter or equal to the management predetermined payback period. Okay? Then number B, for mutually exclusive projects, for mutually exclusive projects, accepts any project with a shorter payback period, provided it is equal to or shorter than management predetermined payback period. I repeat, for mutually exclusive projects, accepts any project with a shorter payback period, provided it is shorter or equal to management predetermined payback period. Okay? So that's that. That's the decision rule. Last week, I explained to you what independent project is all about, what mutually exclusive project is all about. I said independent projects are independent project is a standalone project that may be accepted or rejected based on its own merits. So if the projects produce a positive NPV, for example, you can accept the project. If negative NPV, you reject it. That's an independent project. However, for mutually exclusive projects, we said that mutually exclusive project is a competing project in which the acceptance of one will preclude the acceptance of the other. For example, if project X and Y are mutually exclusive, so if project X is accepted, project Y must be rejected, and vice versa. So these are what we call mutually exclusive project. We discussed it last time. So move on from here. So these are the things you need to know under payback period. So you can read about the advantages and disadvantages. Again, examiner cannot be asking you at this level what is advantages and disadvantages of a payback period. So you are beyond that level. You are not elementary. Now, in case you are asked to calculate discounted payback period, of course, this discounted payback period is under the discounted cash flow method. However, it's the same thing as the normal payback period, except that the cash flows are discounted to the present value equivalent before calculating the payback period. So you need to incorporate time value of money into your calculation before you calculate your payback period. So it's the same procedure that you are going to use for calculating your normal payback period. Yeah, that's that. Then let's talk about accounting rate of return. Wow. Let's talk about accounting rate of return. I want to my mind was doing me, my eyes is doing me why. I wanted to say, is this 11 o'clock? It's just 10 o'clock. So, which is good. I'm happy. So let's talk about accounting rate of return. Again, the accounting rate of return is one of the techniques under the non-discounted cash flow method, which relies heavily on the accounting profits, on the use of accounting profits or loss as shown in the financial statement of a company. The accounting rate of return is a measure of profitability. Okay, accounting rate of return is a measure of profitability, unlike payback period, which measures liquidity. Okay. Now, of course, it's either you call it accounting rate of return, or you call it return on capital employed or return on investments. Is the same thing. Okay, it's the same thing. So the accounting rate of return is the minimum return expected by investors from their investment in a company. Okay, so how do you then calculate accounting rate of return? How do you calculate accounting rate of return? When you want to calculate accounting rate of return, you need to first of all, before you put in the formula for calculating accounting rate of return, the first working that you are going to do in most cases, whenever you want to calculate accounting rate of return, is for you to calculate your depreciation. Okay? You calculate your depreciation. That will be your first working. Okay? Depreciation, as you know, is the cost of the projects minus the scrap value, if any, then divided by the useful life of the projects. So that will give you the annual depreciation. Once you have the annual depreciation, the next working that you are going to do is to calculate average annual profits. So you need to go ahead and calculate working for average annual profits. Let me rewrite this. Average annual profits. Okay, so once you get your average annual profits will depend on the information given to you in the question. If you are given cash flows, and you have to calculate accounting rate of return, remember, accounting rate of return does not make use of cash flows. Rather, it makes use of accounting profit or loss. So if cash flow is given to you, you need to convert it to accounting profit or loss. Therefore, if, for example, cash flow is given to you, I would then say cash flow, annual cash flow minus depreciation, that will give me profits. Then, of course, divide by the useful life. Divide by useful life. Okay. So like I said, the cash flow minus depreciation will give me profits. So total profits divided by the useful life will give me the average annual profits. Okay. So that's that. Then once I'm done with this, the next working I'm going to do will be to calculate average investments. I need to calculate average investment. The average investment is the cost of the projects plus describe value, then divide by 2. Then finally, the working I'm going to do, the next calculation I will do is to calculate average annual, is to calculate accounting rate of return. The accounting rate of return will then be average annual profits, okay? Average annual profits over average investments. Okay, so everything multiplied by 100%. Okay, so that will give me the accounting rate of return. Okay, that's that. So these are the relevant formulas that you are going to need whenever you want to calculate accounting rate of return. Again, most of you are familiar with all of these calculations, so it's just a reminder. All right, so that is that. Then what is the decision rule under accounting rate of return? What is the decision rule under accounting rate of return? For independent projects, you accept if accounting rate of return is greater or equal to management predetermined accounting rate of return. I take it again. For independent projects, accept if the calculated accounting rate of return is greater or equal to the management predetermined accounting rate of return. Okay? Then, for mutually exclusive projects, accept any project with a higher calculated accounting rate of return, provided it is equal to or greater than the management predetermined accounting rate of return. So that's the decision rule under accounting rate of return. Now, you will notice that the two techniques under the non-discounted cash flow method are benchmarked against the targeted management figures. So you are expected to calculate, you are expected to benchmark your calculated payback period or accounting rate of return with the management predetermined payback period or accounting rate of return. So again, there is something I forgot to tell you under the payback period. As far as payback period is concerned, when you want to make a decision, under accounting, under payback period, you don't benchmark your calculated payback period with the useful life of the project. No, you have to benchmark with the management predetermined payback period. So if management targeted payback period is given to you, if it is not given to you, that means there is no basis for the acceptability of the project. Because when you want to make a decision under payback period, you need to compare your calculated payback period with the management predetermined or intended or targeted payback period. So I'm now saying that if the management targeted payback period is not given to you, there will be no basis for the acceptability of the project. So you don't compare your calculated payback period with the useful life of a project. So it has to be with the management predetermined payback period. I believe that is clear. When you have illustration, we are going to discuss that. So we have a particular scenario, a particular illustration whereby you have to use payback period. Then the examiner is asking you to advise on the basis of the payback period whether the project should be accepted. So when we get there, we will see how we are going to treat it. Okay, then again, please go through the advantages and disadvantages of accounting rate of return, and just for you to have the understanding in case examiners have to your hand, and then so to be a bonus for you. So that's that. So let me pause for 1 minute, and then let me know if you have any question for me so that we can move to relevant cash flows. Let's move to relevant cash flows. If you have any question, go ahead. Okay, so in the absence of question, let's move to relevant cash flows. Let me look for space. Okay, let me use the space. Relevant cash flows. Now, because on the day of your exam, examiner will scatter the question for you. When you have question under capital budgeting, the minimum pages, if it's a compulsory question, the minimum pages that will be given to you may be 2. Different scenarios will be painted in the question. So, and different cash flows will be given to you. So you have responsibility to be able to identify which of the cash flows are relevant, which one are not relevant. In this case, your knowledge of performance management will come in handy, will be very useful under this situation. Therefore, you must understand what relevant cash flows are. What are the relevant cash flow? What are the non-relevant cash flows? So let's take it one after the. I will explain each of them, then we'll move to the next one. So we are going under relevant cash flows. We are going to talk about variable cost. Okay. Then 2, we talk about fixed cost. Number 3, we are going to talk about depreciation. Before depreciation, we talk about direct, specific, attributable, or incremental fixed cost. Then 4, we are going to talk about depreciation or amortization or provision. Number 5, we are going to talk about historical costs, okay? Number 6, talk about interest. We talk about sunk costs, or let me just say historical slash sunk costs. Then we are going to talk about interest. Okay, I've already noted that. We'll talk about opportunity costs. Then finally, we are going to talk about, okay, working capital. So let's pick it one after the other. What do you mean by variable cost? How do you treat variable cost when you see it in a question? So variable costs are costs that are directly related to the project under consideration. Examples include direct material, direct labor, direct expenses, and variable overhead. Variable costs are relevant cash flows and should be considered, meaning that in a question, when you see direct material, direct labor, direct expenses, or variable overhead, they are relevant. You have to account for it. It should be part of the cost of the project. Then number 2, fixed costs. Fixed costs are costs that have no sympathy for activity level, meaning that irrespective of the activity level, the fixed cost will not change. Provided the fixed cost will not change, fixed cost is irrelevant and should be ignored when you see it in a question. Now, there are 3 ways examiner can test fixed cost in a question. Pay attention to this. There are 3 ways in which examiner can test fixed cost in a question. When you are given a scenario, examiner just mentioned fixed cost of 100,000 naira. No further information, no additional information. That fixed cost is irrelevant. Please ignore it. Because provided the fixed cost will not change or will not increase, it is irrelevant. Now, another way that examiner can test fixed cost is the examiner may tell you that fixed cost, including depreciation. If you are given a fixed cost that includes depreciation, examiner wants you to do something. Therefore, you need to go ahead and calculate annual depreciation. You less it from the fixed cost. Whatever you have thereafter represents a relevant fixed cost that you are going to use. I repeat, if you are given a fixed cost, that includes depreciation, that is, examiner may say that fixed cost, including depreciation, 100,000 naira. So that 100,000 naira is irrelevant. However, examiner wants you to make adjustments. Therefore, you need to go ahead and calculate annual depreciation. So you less the annual depreciation from the fixed cost that included depreciation. So whatever balance you have thereafter is relevant. Then the third one, examiner can tell you that fixed cost excluding depreciation. So if you are given a fixed cost that excludes depreciation, that fixed cost is relevant. You have to account for it. So those are the three ways in which examiner can test you under fixed cost. So other than that, fixed cost is irrelevant and should be ignored, except it is incremental in nature. So that's that. Then number 3, you may be given direct fixed cost. Examiner can give you specific or attributable fixed cost or incremental fixed cost. All of these are relevant fixed costs and should be considered. So when you are given direct fixed cost, it is relevant. When you are given specific fixed cost, it is relevant. When you are given attributable fixed cost, it's relevant. When you are given incremental fixed cost, it's relevant. So all of those items are relevant. So when you see them in a question, you have to account for them. Number 4, depreciation, amortization, or provision. These are non-cash items. Depreciation, amortization, provision are not cash flows. Okay, they are not cash flows. Therefore, should be ignored in a question. When you see depreciation in a question or amortization or provision, please ignore. It is not relevant. Ignore them. They are not relevant. Then number 5, historical costs. Historical costs are some costs. They are past costs. They are costs that have already been incurred in the past. Therefore, historical cost or some cost is irrelevant and should be ignored. Examples of historical costs include market survey costs, research and development, any preliminary expenses. They are virtually irrelevant, so you should ignore them. Any costs that have been incurred in the past are not relevant, so you have to ignore it. Okay. Then the next item is interest. The absolute amount of interest is irrelevant. When you see interest in a question, the naira amount of interest, this is what I mean by naira amount. In a question, you are given interest. Okay. You are given interest, say, for example, 50,000 naira. So this 50,000 is the absolute amount of interest. That's the naira amount of interest. So when you are given interest amounts, please ignore. It is not relevant because the cost of capital to be used to appraise the project already included interest. So when you are now considering the absolute amount of interest, it means that you are treating interest twice. So you have to, when you see interest in a question, please ignore in capital budgeting or in any investment appraiser. Once you see interest expense or interest amount in a question, ignore it. It is not relevant. Like I said, because the cost of capital to be used to discount the cash flows already included interest. You remember when we calculated cost of capital, we calculated cost of debt, isn't it? So that cost of debt already included the interest. Okay. So there's in your weighted average cost of capital, you already included interest. Your KD is your interest, cost of debt. Therefore, when you are calculating, when you are appraising a project, the naira amount of the interest should always be ignored, because if you include the interest, it means that you are treating interest twice. That means you are double dipping. You are double dipping, and that is not permitted. Okay, you are double dipping. Double dipping simply means when you treat something twice. Okay, you treat something twice, so that means you are double dipping. Then the next item is number 7, opportunity cost. Okay, opportunity cost is a benefit forgone as a result of taking a particular course of action. Okay, opportunity cost is a relevant cash flow and should be considered. So when you have opportunity cost in a question, you have to account for it. You have to take it. It's relevant. The last one is working capital. Okay, working capital. Working capital is the amount required for the day-to-day running of a business. That's a layman definition. An accountant will define working capital as the difference between current asset and current liability. So how do you then treat working capital in a question? Working capital, of course, is relevant. However, how do you treat it when you see working capital in a question? There are 2 ways in which you can treat working capital in a question. You may be given a one-off working capital, one-off working capital. When you are given a one-off working capital, it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. I repeat, when you are given a one-off working capital in a question, it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Let me demonstrate this for you. Say, for example, we have a project that has 3 years life. Year 1, year 2, year 3. And you are now told that the company will incur a working capital of 5,000 naira in year 2. Okay? The company will incur a working capital of 5,000 naira in year 2. So this 5,000 naira working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Remember, the working capital occur at the end of year 2. Okay? Working capital occur of 5,000 naira occur at the end of year 2. So you are not going to record it in that year 2. You are going to treat it as cash outflow in the year before the year of occurrence. So since this working capital occur in year 2, therefore I will go to year 1. Year 1 is the year before year 2. I will put the working capital there. The rule says that it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The useful life of this project is 3 years based on our hypothetical figures. Therefore, you can see the company has recovered its working capital. 5,000 minus 5,000 will give you 0. So the company has recovered the working capital. However, by the time you discount the working capital of year 1 and the one of year 3 recovery, you see that it's not going to be the same thing. It's not going to be the same present value because you have to consider time value of money. So as a result, not the same amount will be recovered. Okay, so that is how to treat a one-off working capital. I will repeat, a one-off working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. That's for that. Then, number 2 is for incremental working capital. Okay, incremental working capital. How do you treat incremental working capital? The incremental working capital should be treated similar to a one-off working capital, okay? Except that only the increments are considered. I repeat, the incremental working capital should be treated the same way as the one-off working capital, except that only the increments are considered. For example, let me use this space. For example, say you are given working capital for year 1, year 2, year 3 for simplicity. Working capital for year 1 is 1,000. Year 2 is 1,200. Year 3 is 1,500. You will notice that working capital is increasing year on year. Therefore, when you want to calculate your working capital, you are supposed to consider only the increment. I would then say incremental working capital. The first year working capital is 1,000. This 1,000 has increased to 1,200. Difference is 200. The 1,200 has increased to 1,500. Difference is 300. So these are the incremental working capital that I'm going to consider. Therefore, I can then include relevant year. So remember, the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The one that occurred in year 1 should be treated as cash outflow in year 0. The one that occurred in year 2 should be treated as cash outflow in year 1. The one that occurred in year 3 should be treated as cash outflow in year 2. Then at the end of the useful life, you recover the entire working capital. The entire working capital is 1,500. When you add up 1,000 plus 200 plus 300 will give us 1,500, which is the working capital you have in that year 3. Therefore, at the end of the useful life, which is year 3, you recover the entire working capital. This is a cash outflow, cash outflow, cash outflow. Then you recover it at the end of the useful life. So this is how to treat incremental working capital. In most of the calculations illustration that we are going to have, you are going to have incremental working capital. Okay, you are going to have incremental working capital. A one-off working capital is not common at this level. Okay, so when we get there, we are going to see the treatment. So that's that. So these are the explanation of relevant cash flow for the purpose of capital budgeting or investment appraisal. Let me know if you have any question for me before we proceed to impact of inflation. We are getting close to the end of explanation of concepts, so that in our next class, what we'll be doing are just calculations all through. Okay. Let me know if you have any question. So far, so good. So if there are no questions, let's talk about impact of inflation. Let me see. Okay, let me use this one to explain so that it will be faster. Now, I will not be telling you what is inflation. You know what inflation is all about. So that's not my target. So I want to explain to you cash flows in relation to inflation. What are the relevant cash flow we have in relation to inflation? What do you mean by money cash flow, real cash flow? What do you mean by money cost of capital, real cost of capital? How do you convert real cash flow to money cash flow or money cash flow to real cash flow? What are the general rules that you must take into consideration? These are the things I want to discuss with you, not defining, not giving you definition for inflation. What are the types of inflation? All those ones are not relevant now. But again, you have the material, you can just go through them and have the understanding. Now, what do you mean by money cash flow? This is an examinable area. This is an examinable area. Examiner has done it severally in the past, where students were asked to explain money cash flows and then real cash flows. So it's important for you to have the understanding. Okay, then. So what do you mean by money cash flow? Money cash flows are cash flows that include the possible effect of inflation. Okay? Money cash flows are cash flows that include the possible effect of inflation. And then, of course, except otherwise stated, the cash flow given to you in the question are assumed to be money cash. So if it calculates or to convert real cash flow to money cash flow, examiner will usually tell you that it is real based on the way it is being given. However, if in the question, if the question is silent as to whether it is money or real, you are going to assume that it is money cash flow. Okay? So when I say money cash flow is the cash flow that include the possible effect of inflation. They are inflated cash flow. Money cash flow are cash flow. They are inflated cash flow. The money cash flow already include inflation. Money cash flow already include inflation. So that's that. Then what is real cash flow? Real cash flows are cash flow that does not consider the possible effect of inflation. Okay? Real cash flows are cash flows that do not consider the possible effect of or that do not include the possible effect of inflation. They are deflated cash flow. They are cash flow that is stated in today's prices, year zero prices, year one prices, or current value terms. Okay, when you are given cash flows, an examiner told you that they are in today's prices or current value terms or year one prices, you should know that they are real cash flow. And real cash flow does not include inflation. Okay, so that is that. Then, how do you convert money cash flow to real cash flow or real cash flow to money cash flow? When you want to convert money cash flow to real cash flow, so you are supposed to discount whenever you are converting money cash flow to real cash flow, you discount. What do I mean by discount? So you want to convert money cash flow to real cash flow. It means that the real cash flow will be the subject of the formula. So you want to convert money cash flow to real cash flow. Therefore, you are going to pick the money cash flow, you multiply with general inflation rates. Okay? You multiply with general inflation rate raised to power minus n. When you do this, it means that you are discounting. Okay? It means you are discounting. So when you want to convert, because money cash flow is already inflated, the money cash flow is already inflated. So you want to convert it to real cash flow equivalent. Therefore, you are supposed to discount it. So for you to discount, so you pick the money cash flow, you multiply with 1 plus general inflation rate, then you raise to power minus n. When you do this, you are simply discounting. You are simply discounting. Then how do you convert real cash flow to money cash flow? So when you want to convert real cash flow to money cash flow, you are supposed to compound it. Remember, the real cash flow does not include inflation. So you want to calculate the cash flow that include inflation. So it means that you have to increase, you have to inflate the real cash flow to the money cash flow equivalent. So to do this, so just pick your real cash flow that is given to you. In most cases, this is the one you are going to use on the day of the exam. So to get the money cash flow, let me write this. So to get the money cash flow, so you pick the real cash flow as given to you. So pick the real cash flow, you multiply with general inflation rates, then raise to power n. So because you are compounding it, so you have to raise it by n. So in this case, by the time you do your calculation, it will give you the inflated cash flow, which is money cash flow. So these are the ways in which you can convert money cash flow to real cash flow or real cash flow to money cash flow. Now, on the day of your exam, all this formula does not matter. It doesn't matter. It's implied in the question. By the time you begin to apply, to do your calculation, you won't make any reference to the formulas you have here. So in most cases, I don't like talking about the formula, all these ones, because there are specific way you're supposed to calculate when we. So in any case, when we get there, you will see live questions. All right. So by then you understand better. Okay. Of course, at year zero, money cash flow will be equal to real cash flow. By the time you put n, your n is equal to 0. Anything raised to power 0 is equal to 1. Therefore, money cash flow will be equal to real cash flow. Now, Again, how do you determine money cost of capital or real cost of capital? How do you determine money cost of capital or real cost of capital? So when you want to calculate money cost of capital, you need Fisher effective formula to calculate your money cost of capital. But before that, what is money cost of capital? What is real cost of capital? The money cost of capital is also known as money rate of return, okay, or nominal rate of return. Money rate of return or nominal rate of return. It is the cost of capital that include the possible effect of inflation. It is the cost of capital that include the possible effect of inflation. And unless otherwise stated, the cost of capital given is assumed to be money cost of capital. In the question, once you are given cost of capital and an examiner did not tell you it is real cost of capital, you are going to assume it's money cost of capital. Then, what is real cost of capital? The real cost of capital is the one that does not consider or that does not include the possible effect of inflation. It's a cost of capital that is stated in real terms, okay? The real cost of capital is a cost of capital that is stated in real terms. So when you want to calculate cost of capital for the purpose of inflation, you are going to need Professor Ivan Fisher effect formula to compute your cost of capital. According to Professor Ivan Fisher, let me see, space, okay. So according to Professor Ivan Fisher, of course, Ivan Fisher is an economist. So 1 plus money cost of capital is given as 1 plus real cost of capital multiplied by 1 plus general inflation rate. So this is the original formula of Ivan Fisher. M is the money cost of capital, R is the real cost of capital, I is the general inflation rate. So with this formula, you can use it to calculate money cost of capital. If I want to calculate money cost of capital, I want to make this M the subject of the formula. Therefore, all I need to do is to just say M equal to 1 plus R multiplied by 1 plus general inflation rate. The one that is standing behind the M will then move to the other side, which is minus 1. So when I want to calculate money cost of capital, this is the formula you are expected to use. From the original formula, if I want to calculate real cost of capital, which is R, then I need to divide both sides by 1 plus I, because this 1 plus I is disturbing 1 plus R. So I would then say I need to divide both sides by I. Therefore, I would then say R equal to 1 plus M divided by 1 plus I, or minus 1. So this is the formula for calculating real cost of capital. That's the formula for calculating real cost of capital. Then, if you are given real money cost of capital and real cost of capital, and general inflation rate is not given to you, from this Ivan Fisher effect formula, I can also get my general inflation rate. My general inflation rate is the high. Therefore, I, just the same way you calculate your real cost of capital, I will be equal to 1 plus M over 1 plus R, or minus 1. That's it. That's it. This is how to calculate general inflation rates. So these are the formula for calculating money cost of capital, real cost of capital, as well as the general inflation rate. At times, examiner can ask you to explain what real rate of return and money rate of return is all about. So you need to talk about all of these things, and then you demonstrate in the formula I just gave to you to buttress your points, okay? So finally, Under inflation, let's talk about general rules. Let's talk about general rules. What are the general rules? Now, there are specific rules that you must apply when you want to incorporate inflation in your cash flows. Rule number one is that money cost of capital must be used for money cash flow. I repeat, rule number one, money cost of capital must be used for money cash flows. Rule number two, real cost of capital must be used for real cash flows. I repeat, real cost of capital must be used for real cash flows. Rule number three, do not use money cost of capital for real cash flows. Do not use money cost of capital for real cash flows. Number four, do not use real cost of capital for money cash flows. Do not use real cost of capital for money cash flows. But most importantly, when cash flows, this is the one you are going to need. All those ones do not use money cost of capital for real cash flow. They are irrelevant to me. When you want to calculate your cash flows, when you want to inflate your cash flows, the major thing you need to take into consideration are the additional information I put here. You can't see it anywhere. Where cash flows are stated in year one prices or first year prices, inflation should start from year two. Meaning that once you are told in the question that the cash flow given to you is in year one prices or first year prices, you don't inflate year one prices. You have to start inflating from year two because your year one price represents the base year price. Your year one price represents the base year price, which you are going to use to project for the future cash flows. Therefore, you don't inflate year one prices. Now, if you are told in a question that the cash flow is stated in today's prices, year zero prices, or current value terms, then inflation should start from year one. At times, examiner can tell you that selling price in current value terms equal to 2,000 naira. So because the examiner has mentioned current value terms, so you should know that it is real cash flow. Examiner can also tell you that variable cost in the first year is 1,000 naira. Examiner has mentioned first year. That means it's in first year price. First year price represents real cash flow. So I need to inflate it. So these are the things you need to take into consideration. Okay, so that's that. So finally, let's talk about impact of taxation. Again, please talk to me if you have any question for me. If you have any question, let me know. So we are moving to impact of taxation. Let's talk about taxation. How do you incorporate tax in capital investments? Okay. Now, the primary purpose of incorporating tax in capital investments, there are three main reasons. There are three main reasons or purpose of incorporating taxation in project evaluation or investment appraisal. One is to determine the tax liability. You want to know how much tax will be paid on the cash flow generated by the project. Then two, to determine the tax saved on capital allowance. Okay, the essence of tax saved, the essence of capital allowance or tax saved on capital allowance is to reduce tax liability. Okay, you want to use tax saved or capital allowance to reduce your profitability and in effect to reduce your tax the company will pay. So that's essence of calculating capital allowance. Then, of course, the third reason or purpose of incorporating tax in project evaluation is to determine the timing of the cash flows. You want to know when is the company going to pay the tax liability, or when is the company going to claim the capital allowance? So that is the timing of the cash flows. Now, what are the major types of capital allowance? What are the major types of capital allowance? Okay. There are 4 different types of capital allowance in relation to finance, or for the purpose of finance. There are 4 types of capital allowance. We have 1, initial allowance, then 2, annual allowance, 3, balancing allowance, then 4, balancing charge. Therefore, what do you mean by initial allowance? The initial allowance is an allowance claimable once in the lifetime of the assets. That is, once the initial allowance is claimed in the first year, the company cannot claim it again. It's only once in the lifetime of the assets. So to get your initial allowance, just multiply the initial allowance rates on the cost of the assets. So going forward, what the company will be claiming will be the annual allowance. Therefore, what do you mean by annual allowance? The annual allowance is an allowance claimable every year until the final disposal of the assets. So every year, from year 1 to the final day of the assets, the company will continue to claim annual allowance. So once the asset is disposed of, then the company will stop claiming annual allowance. And that's why it is said that annual allowance is an allowance claimable every year until the final disposal of the assets. Then the third one, which is balancing allowance. The balancing allowance will arise when greater than the sales proceed. I repeat, the balancing allowance will arise when the tax written down value from the preceding year is greater than the sales proceed. Once your tax written down value is greater than sales proceed, it is called balancing allowance. Okay, so the difference between the tax written down value and the sales proceed will represent the balancing allowance, which represent a taxable profit that the company will benefit. Okay. Then balancing charge. Balancing charge is just an opposite of the balancing allowance. The balancing charge will occur when the tax written down value from the preceding year is less than the sales proceed. So when this happens, it means that the company has earned additional gain or profit on the disposal of the assets. Therefore, the extra the company has benefited or the company has earned will be taxed in the hand of the company. This is called taxable loss. This is called taxable loss. Okay, so that is that. So of course, in most cases, examiner will not give to you initial allowance rates. Okay, you are not going to be given the initial allowance rates. Of course, the depreciation, straight line depreciation, capital allowance will surely be given to you on an annual basis. Therefore, so you are going to be having only annual allowance until the final day of the asset, when the asset will be disposed of. So at that final day, you can either have balancing allowance or balancing charge. Okay, you can either have balancing allowance or balancing charge, but you cannot have the two of them. So it has to be either of the two. So what are the methods of claiming capital allowance? There are basically 2 methods. You can either use straight line depreciation method or you use reducing balance basis. Okay, so if it's on a straight line basis, the same amount is what you are going to have. The same capital allowance will be claimed every year until the final disposal of the assets, when you need to compare the tax written down value versus the sales proceed to get balancing allowance or balancing charge. But if you are using reducing balancing basis to calculate your capital allowance, so you are going to multiply the company tax rates you are going to multiply the capital allowance rates on the tax written down value every year until the final disposal of the asset, okay, to get the balancing allowance or balancing charge. Okay, so that's that. Finally, remember, I also said that one of the reasons for incorporating tax in investment appraisal is to determine the timing of the cash flow. That is, when to pay tax liability or to claim capital allowance. Okay, when to pay tax liability or to claim capital allowance. So tax can be paid or capital allowance claimed, okay, in the relevant year, either in the current year, okay, either in the current year, that is the year the profit is earned, or in arrears, that is 1 year after. So if the examiner is silent as to when the company is supposed to pay the tax liability or claim the capital allowance, we are going to assume that it is in the current year. But if you are told specifically in the question that tax will be paid in the following year, or that is 1 year after, in arrears, then you consider this. However, the tax liability, the capital allowance must follow the pattern of the tax liability at all times. I repeat, the capital allowance must follow the pattern of tax liability at all times, meaning that if tax liability is paid in the current year, your capital allowance must be claimed in the current year. If tax liability is paid in arrears, your capital allowance must also be paid, must be claimed in arrears. So that's what I said, that capital allowance must follow the patterns of the tax liability. So that's that. Finally, I want to give you the formats. I've already told you the reasons. I've already told you the reasons for calculating capital allowance. The essence of capital allowance is to reduce taxable profits and, in effect, reduce tax liability. So as a result, as a direct consequence for incurring qualifying capital expenditure. So that's that. Okay then, how do you calculate? Before I give you a format for calculating NPV, IRR, whatever techniques, let me first of all show you how to calculate tax saved on capital allowance. Okay, when you want to calculate tax saved on capital allowance, this is the format. This is the format you are supposed to use. So the essence, the thing you want to use, it depends on whether you want to use capital allowance to reduce liability, to reduce your tax liability, or you want to use tax saved on capital allowance to reduce your tax liability. But first thing first, when you want to calculate your capital allowance, you create a column for year, the next column for narration or description or item, then another column for cost. So to get your capital allowance, you start from year 0, the cost of the assets, then of course you put the cost of the asset there. In year 1, the company will need to claim annual allowance plus initial allowance. So if initial allowance is given to you in the question, you are going to multiply the initial allowance rates on the cost of the assets. Okay, you multiply the initial allowance rate on the cost of the asset, whatever you have, you post. You go back to the question, you multiply annual allowance rates. Okay, you multiply annual allowance rates on the cost of the asset also in year 1. So you add the two of them together, whatever you have, you come and post here. That will be your capital allowance in the first year. In the second year, of course, by the time you less the capital allowance of the first year from the cost of the assets, this will give you the tax written down value at the end of year 1. So as you are moving to year 2, you are supposed to claim your capital allowance, your annual allowance. So in this case, it will depend on whether the capital allowance is on a straight line basis or reducing balancing basis. So we're assuming that it's on a reducing balancing basis. So if it's on a reducing balancing basis, just multiply the annual allowance rate on the tax written down value to get this number. Okay? Then, of course, you deduct, you get your tax written down value. So on this table, our assumption is that this asset has 3 years life, or this project has 3 years life. Therefore, at the final year, the asset will be disposed of. The asset will be disposed of. Therefore, this final year, you need to compare the sales proceed versus the tax written down value. So if the tax written down value is greater than the sales proceed, it is called balancing allowance, like I said the other time. But if tax written down value from the preceding year is less than the sales proceed, then it is called balancing charge. So if it is balancing charge, you put your final answer in brackets. If it is balancing allowance, it is a plus, okay? So if I want to use capital allowance to reduce my tax liability, all the capital allowance I've computed, all these ones, number 1, number 2, then number 3, those are the capital allowance. So if I want to use capital allowance to reduce my tax liability, what I need to do is to pick the profit for each year. Say, for example, we have profits for year 1, year 2, year 3. Whatever I have there as the profits in the question as given to me or in my calculation, that's my profit. So I need to put my capital allowance here because I want to reduce my tax liability. So you need to first of all deduct capital allowance from the profit to have taxable profit. So I'll need to do all my calculation that I've done here, all this calculation of capital allowance, the 1, the 2, the 3. I will then come and less. I will less this. So whatever I have thereafter will represent taxable profits. Taxable profits. So it is on this taxable profit I'm going to charge tax liability. Tax at whatever the rate that is given to me in the question, I will multiply it on the taxable profits. Okay? So that will be my tax liability. Whatever I have thereafter. So that will be my tax liability. What's wrong with you? Okay? So that's my tax liability. So it is this tax liability I will now put under my table for calculating NPV. Okay, so using capital allowance, this is the format I will follow. If I want to use capital allowance to reduce my tax liability, this is the format you are supposed to follow, you are supposed to use. However, if I want to use tax saved on capital allowance to reduce my tax liability, I need to go a step further. Okay, I will go a step further. After calculating the capital allowance for each year, I need to multiply company tax rates on the capital allowance. So say, for example, if the tax rate is 30%, the capital allowance I've calculated in in year 1, I will multiply 30% of it. I will get this. In year 2, I will multiply 30% to get this. Then year 3, you also get this. This year, the final year could either be positive or negative, depending on whether it is balancing allowance or balancing charge. So that is that. Now, if I'm using tax saved on capital allowance, I can quickly check to know whether my because you can't claim more than the capital allowance you are supposed to claim. Therefore, to confirm that I've not claimed beyond or above what I'm supposed to claim, I can confirm that. I can say total tax saved equal to the cost of the assets plus the scrap value multiplied by company tax rate. So when I do this, whatever answer I get will be equal to the total of all of this. Will be equal to the total of all of this. This is total tax saved. All right? So I will just use this formula to confirm that what I've claimed is the same thing. All right? So that's for that. Then, of course, that's it. So finally, let me just I'll show you the format. The format is not in this material. Okay, let me just show you the format to use to calculate MPV. Let me see if I can get a big space to quickly do that within the next few minutes. Okay, no, this is not sufficient. Let me use my working notes. Okay. So if I want to calculate MPV, if you want to calculate MPV, this is the format you are supposed to use. Use format is used when you have multiple variables. In the question, you have sales value, you have variable cost, you have incremental attributable specific fixed cost, you have taxation, you have inflation, you have scrap value, you have working capital. So you have different kinds of variables. In that case, you cannot use the small table you normally use for calculating your MPV. You have to use the columnar format. In this case, I can just say calculating net present value. For example, figures in millions. Say this project has 3 years life. Therefore, we have year 0, year 1, year 2, year 3. So you can create additional column for workings. So the first item here will be sales. How do I calculate my sales? I will go to the question. Am I given selling price? If yes, I will go back to the question. Am I given inflation on selling price? If yes, then I need to go and inflate my selling price. Once I inflate the selling price, I will multiply with number of units sold. Then I will come and post. That will be my working number 1. Then I will go back to the question. Am I given variable cost? If yes, then I will come and put variable cost here. To get my variable cost, I will go to the question, what's the variable cost per unit? Am I given inflation? If there's inflation, I need to inflate the variable cost per unit. After inflating the variable cost per unit, I will multiply with number of units produced. Then I will come and post. This is working number 2. Again, I will go back to the question. It is possible I might have direct, specific, or attributable fixed cost. Whatever it is, I don't need to go and do working for my attributable fixed cost. However, once I'm given incremental, direct, specific, or attributable fixed cost, and there's inflation in the question, I don't need to do working for this. I'll just use my calculator to multiply the fixed cost with the inflation, and then I will move on. So whatever it is, I will post. Then after this, I need to find the profits. Okay, this will give me profits. After profit, I'm supposed to pay tax. Anytime there is profit, you must pay tax. So the next item will then be tax at company tax rates. So I will multiply company tax rates on the profit, on the taxable profits. The format I'm using here is that we are using tax saved on capital allowance to reduce our tax liability. Okay, we are using tax saved on capital allowance to reduce your tax liability. That is the format I'm giving you. If I want to use capital allowance to reduce my tax liability, I need to go and calculate my tax liability. This item, I need to go and calculate it separately. Then I will come and post. The way I demonstrated the other time on the other note. So immediately after tax liability, I need to consider tax saved. Tax saved on capital allowance. I will go and do my working for tax saved on capital allowance. Then I will come and post. Remember, the essence of tax saved on capital allowance is to reduce tax liability. So the next item would then be scrap value or sales proceed. Okay. You may have scrap value in the question, which will occur at the final year. Okay. Then the next item you need to consider will then be the initial outlay. The initial outlay, which will occur in year 0. The cash outflow, initial outlay will occur in year 0. Then it is also possible in the question you may have working capital. So if you have working capital, it depends on whether the working capital is incremental or a one-off. Based on these formats, we are assuming that the working capital is a one-off working capital that will occur in year 1, which should be treated as cash outflow in year 0. Therefore, I have it here. Then at the end of the useful life, we recover the working capital. Then at this point, we need to get the net cash flow. So here is net cash flow. After getting the net cash flow, we need to discount it at the appropriate cost of capital. It is possible in the question the examiner may not give to you cost of capital. You may be the one to calculate the cost of capital. It all depends on the scenario. All right. So, but we are assuming that the cost of capital is given. Therefore, I need to have my discount factor. Discount factor at whatever percentage cost of capital. For year 0 is 1. I will do this. Then I will multiply. Okay, once I multiply, I will get the present value. This is the present value. After present value, the difference between present value of cash inflow and cash outflow represents the NPV. Therefore, my NPV could be positive or it could be negative. So this is the columnar format for calculating NPV. The good thing about this format is that once you get your net cash flow, you can use it to calculate anything. You can calculate internal rate of return. You can calculate project duration. You can calculate modified internal rate of return. You can calculate adjusted present value. Once you get to your net cash flow, you can use it to calculate using any technique. So this is how to calculate NPV, and these are all the explanations under capital budgeting. So I'm done explaining the concepts. So the next thing we are going to do in our next class, by the grace of God, is to have illustrations. So we have 2 more periods to complete this, because we are going to have different scenario questions. So that's that. So let me know if you have any question for me so that we can close the class for today.